Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
So imagine, walking into a corporate boardroom right now, and the CEO just looks at the executive team and says, we are liquidating our professional soccer teams.
Right, just completely out of nowhere.
Yeah, just we are selling off the stadiums, the player contracts, all the merchandise rights, all of it, just so we can afford to buy server space on a blockchain.
It sounds completely unhinged.
I mean, you'd think the CEO had totally lost their mind. But in early 2026, that is not a hypothetical scenario. That is a very real, hyper-aggressive corporate strategy that is playing out right now.
And it's really a perfect illustration of just how fast the tectonic plates of global finance are shifting. Because traditionally, re-architecting the global economy is this process that moves at a glacial pace.
Oh, absolutely.
I mean, it took decades for credit cards to just become the default over cash.
Yeah.
But today, the worlds of traditional centralized finance and decentralized digital assets, they are just colliding in real time.
And to help you, the listener, kind of navigate this collision, we are pulling apart a massive, highly detailed piece of source material for today's deep dive.
Yeah, it's a big one.
It really is. It's an audio briefing recorded on March 12th, 2026, straight out of Dubai. And it is dense, it's data-rich, and it just covers an incredible amount of ground. We are talking global macroeconomic indicators, geopolitical flashpoints, all the way down to, granular daily blockchain metrics.
What makes this specific briefing so valuable, though, is how it captures the cause and effect. It doesn't just look at what central banks are doing in total isolation.
Right.
It actually maps out exactly how those massive top-down governmental decisions are forcing these micro-reactions on the ground in the cryptocurrency market.
Okay, so let's unpack this. Because our mission today is to connect those dots. We want to decode how this digital revolution is basically bleeding into your physical reality. And to do that, we have to start with the biggest, heaviest anchor in the global financial sea, which is the U.S. economy.
Which, according to the February 2026 data from the Bureau of Labor Statistics, is exhibiting a level of stability that is frankly catching a lot of analysts off guard.
Yeah, the inflation rate.
Exactly. The annual inflation rate has settled at a very manageable 2.4%.
That 2.4% number is huge.
Yeah.
The briefing breaks down the BLs.gov data, and the internal mechanics there are just fascinating because energy prices are only up 0.5% over the year.
Wow.
Yeah, and food is up 3.1%. Core inflation, which, strips out those volatile food and energy sectors, that rose 2.5%. But the detail that really stands out to me is that prices for things like used cars and personal care actually declined.
That's a massive shift.
Right. It signals that the huge supply chain disruptions we've dealt with for years are finally truly unwinding.
And if we look at why that specific 2.4% figure matters so much to a highly speculative space like digital assets, well, it all comes down to the psychology of predictability.
Okay, say more about that.
Well, when inflation is wild, businesses and households are just in this defensive crouch. You don't take risks when you literally don't know what groceries will cost next month.
Yeah, that makes sense.
But at 2.4%, that fear that's been paralyzing the market, it starts to evaporate. People can actually plan their budgets, and institutions can model their risk.
And that evaporation of fear, it is showing up immediately in the raw capital flows.
Yeah.
The source material notes that in just the 24 hours prior to the briefing, the market saw $259.5 million pouring into crypto ETFs.
That is a mountain of institutional cash just moving off the sideline.
It really is.
We can actually track that psychological shift in the data, too. The briefing monitors these market sentiment metrics, which recently bottomed out at a score of 24.
Which is pretty low.
Right. In the context of this index, 24 represents extreme fear. But on the back of this stable economic data, that score has ticked up to 27.
So moving us from extreme fear to just, standard run-of-the-mill fear.
Exactly. But it's trending toward neutral, and that momentum is what matters. When that defensive crouch ends, the capital searches for yield, which is what's driving those massive ETF inflows.
But, and this is a big but, the source material is very careful to contextualize this domestic stability against a much darker global backdrop.
Yeah. The briefing extensively covers the ongoing geopolitical tensions, specifically highlighting what they call Operation Epic Fury.
Right.
This is a major conflict in the Straits of Hormuz between the U.S. and Iran, which the source notes was initiated in March under the Trump administration.
And just to pause here and be super clear for you listening, we're just impartially reporting what the source material claims here. We're not endorsing any political viewpoints or taking sides.
Right, we're just analyzing the market impact.
Exactly. So the briefing details some specific claims regarding this operation. It notes that the administration's stated goal is seeking regional peace, and it points out that earlier tariffs implemented by the administration did not cause the domestic inflation spikes that some economists had warned about.
Yeah, from a purely analytical standpoint, regardless of your politics, a conflict in a massive shipping bottleneck like the Straits of Hormuz is a huge lever.
Oh, massive.
It dictates the flow of global trade, oil prices, and by extension, the entire global market's appetite for risk. Geopolitics functions as the weather system for global finance.
I like that analogy.
Thanks. A storm in the Straits of Hormuz creates ripples that eventually crash onto the shores of the digital asset markets. Investors have to price in the possibility of sudden supply shocks, even while the domestic indicators in the U.S. look really calm.
So we have this fascinating macro environment, right? We've got stable inflation at home, severe tension abroad, but an overall thawing of market fear. Let's kind of look under the hood and see how this is actually playing out in the daily crypto metrics, because the briefing highlights a massive contradiction here.
Yeah, the top line numbers are just staggering. Bitcoin is holding strong above the $70,000 threshold, boasting a market capitalization of $1.41 trillion.
$1.41 trillion. And the global crypto market as a whole is sitting at $2.48 trillion. But here is where the source material exposes this glaring, almost embarrassing discrepancy for the crypto purists.
Yeah, this is the really interesting part.
The decentralized exchange, or DEX dominance, is sitting at a dreadful 19.92%.
Wow.
The 24-hour volume for every decentralized exchange combined was only $8.13 billion. And I really have to push back on the entire prevailing narrative of this industry here.
Go for it.
Well, Ethereum has been operating for over a decade. The entire philosophical bedrock of crypto is decentralization, right?
Right.
Removing the middlemen, taking self-custody of your assets. So why on earth is DEX dominance completely stalled out under 20%?
It's a great question.
It's like we've built this revolutionary futuristic fleet of electric cars, but almost everyone is still lining up at the old centralized gas stations to fuel them.
That analogy perfectly captures the friction between ideological purity and just basic human convenience. To understand the scale of the retreat, the briefing points out that back in the peak bull market of 2024, DEX dominance was commanding roughly 40 to 50% of the market.
Wow, so it's been more than cut in half in just 2 years.
It has. Even with top platforms actively facilitating trades, Uniswap is leading the pack with 1.62 billion in 24-hour volume, followed by PancakeSwap, Pump, Solfi, and Orca. They're completely dwarfed by the centralized side of the house. You can see this most clearly in the stablecoin market.
The stablecoin numbers are just massive. The total stablecoin market cap is $314.78 billion, and Tether or USDT alone makes up $85 billion of that pie.
And we really have to explain why that is a structural vulnerability, because stablecoins are essentially digital fiat. They're tokens pegged to the value of a traditional dollar.
Right.
But to maintain that peg, a centralized entity has to hold actual US dollars in a traditional bank account. That means they are inherently centralized.
Which means the issuer can just freeze those tokens at any time.
Exactly. If the masses are overwhelmingly relying on centralized stablecoins and centralized exchanges to interact with decentralized networks, the entire ecosystem is built on a massive centralized point of failure.
Which provides this huge strategic opening. If retail users and institutions are clearly signaling that they actually prefer the convenience and familiarity of centralized infrastructure, it makes perfect sense that the legacy financial empires are stepping in to claim that territory.
Oh, absolutely.
They are looking at that 19% DEX dominance and realizing the crypto community totally failed to replace them.
Which brings us to the European Central Bank.
Right. The ECB is making a monumental play here. The briefing details their AIA initiative. This is a comprehensive, meticulously planned roadmap to build a fully tokenized European financial ecosystem by 2028.
They're essentially building a tokenized euro.
But the briefing is very clear about how this technology actually works under the hood. They are using distributed ledger technology, or DLT, to make wholesale market transfers instantly settle without all those traditional multi-day waiting periods.
But they are designing this explicitly to ensure that central bank money remains the absolute, unquestioned anchor of the system.
Right. They want the mechanical efficiency of the blockchain, but they demand absolute control. The source actually outlines a critical comparison between open blockchains like Bitcoin, where anyone can run the software and verify transactions, and the permission blockchains that central banks will use.
Yeah, the briefing lists 5 classical dangers associated with these permission closed-loop systems.
Right, let me list them out. The 5 dangers are centralization, lack of transparency, censorship potential, reduced innovation, and interoperability challenges. Okay, so I completely understand the first 3.
Sure.
If the ECB runs the servers, it's centralized, it's opaque to the public, and they can censor any transaction they want. But I really have to challenge the source on the reduced innovation point.
How so?
Well, doesn't the open, permissionless blockchain community famously take literally years to agree on even the most minor software upgrades?
That's true. It takes forever.
It's like herding cats across a global forum of anonymous developers. So in the cutthroat, hyper-competitive legacy financial sector, wouldn't a permissioned, centrally controlled system actually allow a bank to innovate and execute much faster?
That is a really crucial distinction, because the open source community fosters radical foundational innovation, like they invent the core concepts.
Right.
But because they require global consensus from thousands of independent node operators to change the code, implementation is agonizingly slow.
Yeah.
In a permissioned environment controlled by the ECB, if the board of directors decides they want to deploy a new programmable feature on Tuesday, well, it goes live on Tuesday.
Exactly.
They have the corporate efficiency to implement rapid, highly focused, and strictly legally compliant upgrades.
And we are seeing that aggressive corporate efficiency everywhere right now.
Yeah.
The legacy players and the centralized crypto giants are making massive offensive and defensive moves to secure their monopolies. The source highlights Binance, for instance, going to war in legacy courtrooms.
Yeah, Binance filed a major defamation lawsuit against the Wall Street Journal over a report published on February 23rd. The journal apparently published rumors suggesting Binance was going belly up, which, inevitably triggers regulatory scrutiny and widespread market panic.
And Binance is fighting back by aggressively marketing their compliance metrics. They are touting a 96.8% reduction in sanctions-related exposure and arguing that this stringent compliance is exactly how they are protecting their base of over 300 million users.
It proves these companies aren't just rogue offshore casinos anymore. They are integrated, litigious corporate behemoths.
Yeah, they are fully playing the corporate game. And while Binance is defending its territory, MasterCard is actively co-opting the entire space.
This part of the briefing is staggering.
It really is. MasterCard has launched what they call a crypto partner program. And they haven't just partnered with one or two startups. They have onboarded over 85 crypto-native companies.
That's a huge network.
We're talking about heavy hitters like Binance, Coinbase, Paxos, Polygon, and Ledger.
Think about traditional banking rails as a massive, sprawling network of paved roads. They are heavily regulated, very safe, but speed limits are strictly enforced. Crypto networks are like off-road vehicles.
Okay.
They are incredibly fast, they're programmable, and they can go anywhere instantly, but they are chaotic. So MasterCard is essentially building a hybrid engine. They want to take the programmability and instant settlement of digital assets and integrate it directly into their legacy paved roads.
So they want you to be able to swipe your card at a coffee shop and instantly trigger a complex smart contract on the back end without you ever knowing you just interacted with a blockchain. But it's not just the digital financial plumbing that is being rebuilt. This technology is literally moving off the servers and into the concrete. It is starting to dictate how our physical cities are built and managed.
Which takes us to the Dubai International Finance Center, the DIFC, and their PropTech 2033 white paper.
Right.
Dubai is aggressively positioning itself as the global capital of the future, and their blueprint for real estate is called PropTech 3.0.
I mean, PropTech 3.0 sounds like a marketing buzzword, but the mechanics described in the briefing are wild. It is the integration of deep tech, specifically artificial intelligence, the Internet of Things, and blockchain directly into urban infrastructure.
It basically transforms a static skyscraper into an intelligent organism. You have Internet of Things sensors embedded throughout the physical building, constantly pulling in data, and then the AI processes that data to dynamically optimize air quality, regulate temperature zones based on human occupancy, and just slash energy waste.
So if the IoT sensors are the nervous system, and the AI is the brain managing the building's physical environment, where does the blockchain come in?
Yeah.
Like if I'm buying a condo in one of these smart buildings, I'm assuming the blockchain acts as the ultimate unhackable property ledger.
Precisely. It fundamentally changes the administrative reality of real estate because traditionally, buying property involves immense friction.
Oh yeah, it's a nightmare.
You need escrow agents, title companies, notaries, and mountains of paper contracts, all of which take 30 days to clear. But by putting the deed on a blockchain, ownership becomes a token. Transferring $1 million piece of real estate becomes as fast and frictionless as sending an email.
And the briefing notes that removing this friction isn't just a fun technological experiment, right?
Yeah.
It is a calculated macroeconomic strategy to drive foreign direct investment into the UAE.
Exactly.
If you make it mathematically simple and legally ironclad for an investor in Tokyo or New York to buy a fraction of a commercial building in Dubai instantly, the global capital will just flood in.
And the corporate world is hyper aware of this geographical and technological shift toward the UAE. Companies are completely restructuring their entire business models to get in on the ground floor.
Which brings us back to that wild boardroom scenario I mentioned at the very beginning of this deep dive. The company formerly known as Brea Holding PLC, they have rebranded to Soulmate.
Soulmate's pivot is just a masterclass in ruthless capital reallocation.
They are attempting to become a massive UAE-centric Solana hub based out of Abu Dhabi. But building out that kind of blockchain infrastructure requires incredible amounts of liquid cash.
Tons of it.
So, to free up that capital, they're literally winding down two underperforming professional soccer teams that they own, Brea Chime and Brea Ilch. They are keeping their flagship Italian club, but shedding the dead weight.
To understand why they need so much capital, you really have to look at what becoming a Solana hub actually entails.
Okay, break that down for us.
Well, they are likely setting up enterprise-grade validators. A validator is the high-powered server infrastructure that actually processes and secures the transactions on a blockchain network. But to run a major validator, you have to stake or lock up massive amounts of the network's native cryptocurrency as collateral.
So you need the money to buy the coins just to run the machine.
Right. It is a highly capital-intensive operation.
So they are literally trading stadium seats for server racks.
Yeah.
And they are executing corporate maneuvers to make sure Wall Street takes them seriously. They're proposing a 1-for-10 reverse stock split scheduled for April 7th, 2026.
Right.
And they will be trading on the NASDAQ under the ticker symbol SLMT. By artificially reducing the number of shares, they drive the price per share up, which keeps them from looking like a penny stock and attracts serious institutional investment.
Whether we are looking at the European Central Bank building closed-loop digital ledgers, or Dubai tokenizing the deeds to its skyscrapers, or Soulmate liquidating sports teams to run Solana validators, all of these disparate events are pointing toward the defining economic buzzword of 2026.
Tokenization. The idea that every physical and digital asset in the world will eventually be represented by a digital token on a ledger. And this perfectly sets up a fantastic question the source material integrates from a listener named Sandy.
Oh yeah, Sandy's question.
Sandy asked, will traditional financial institutions accelerate their move into blockchain infrastructure due to the tokenization hype?
Well, to answer Sandy, we have to look at where this specific wave of hype actually originated. Because the current tokenization frenzy didn't start on a fringe internet forum. It was ignited by Larry Fink, the CEO of BlackRock.
Right. Immediately after the Bitcoin ETFs were finally approved by regulators, Larry Fink went on mainstream financial television and essentially said, the ETFs are a nice first step, but the actual technological revolution is the tokenization of every financial asset.
And when the head of a firm managing $10 trillion speaks, the entire global market realigns to follow.
Yeah, you listen.
But as the briefing smartly contextualizes, we really have to view this current frenzy through the historical lens of crypto narrative cycles. This industry reinvents its core identity every few years.
I really love how the source broke this history down. Because if you've been around the digital asset space for a while, you've lived through these distinct eras.
Oh, yeah.
In 2013, the only narrative was internet money. The biggest question was whether you could convince a merchant to let you buy a pizza with Bitcoin. Then, from 2014 to 2016, Ethereum launched, and the buzzword shifted entirely to smart contracts, the idea of programmable money.
Then the cycle accelerated. From 2017 to 2019, people realized those smart contracts allowed anyone to raise capital instantly. That sparked the era of initial coin offerings, ICOs, and the foundational building blocks of decentralized finance, or DeFi.
And then came the post-2020 madness. The narrative violently shifted to NFTs and the metaverse. We watched people buy digital pictures of cartoon apes for millions of dollars.
That was crazy.
And massive tech conglomerates pivoted their entire corporate identities based on the hype. The source specifically calls out Meta, formerly Facebook, who publicly admitted they made a $70 billion miscalculation regarding their massive push into virtual reality and the metaverse.
Which brings us to the crux of Sandy's question, right? Is tokenization just the next ephemeral hype cycle destined to burn out? Or is it a permanent structural shift in the plumbing of global finance?
Well, based on the deep synthesis provided in the source material, here is the verdict for Sandy and for you listening right now. Traditional banking institutions are likely going to drag their feet and hesitate for the next year or two.
Why is that?
Because of the sunk cost fallacy and extreme risk aversion. They have massive 50-year-old legacy database systems that they have spent billions of dollars securing. You don't just scrap the architecture of a global bank overnight because a new technology is faster.
No, they will defend their moats for as long as possible. But eventually, the sheer math of the efficiency gains will force them to capitulate. They will adopt tokenization.
But on their terms.
Exactly, and this is the critical distinction. They will only do so once there are crystal clear regulatory frameworks in place, guidelines like the ones currently being pioneered by Dubai's Virtual Asset Regulatory Authority.
Right.
And when they do adopt it, they are almost certainly going to build on permissioned, centralized software. They are not going to surrender their networks to the open, public blockchains that the early crypto cypherpunks envisioned.
They will absolutely use the technology to upgrade their own profit margins and settlement speeds, but they will ensure their hands remain firmly clamped on the steering wheel.
Which neatly brings us full circle to the macro picture we started with.
Yeah, let's recap the enormous amount of ground we've covered today. We started at the top, looking at a stabilized 2.4% U.S. inflation rate that is finally allowing households to breathe and plan, which in turn is driving massive institutional ETF inflows and pulling global market sentiment away from the brink of extreme fear.
And then we examine the internal contradictions of the crypto ecosystem, where decentralized exchanges are languishing under 20% market dominance, while users overwhelmingly default to the convenience of centralized stablecoins.
We watched the traditional empires strike back, with the European Central Bank rolling out a meticulously controlled roadmap for a tokenized euro, and MasterCard brilliantly wrangling 85 different crypto companies into a partner program designed to merge blockchain speed with legacy card networks.
We saw how this foundational technology is escaping the digital realm and bleeding into the physical world through Dubai's PropTech 2033 vision for AI-managed, blockchain-enabled skyscrapers.
Right.
And Soulmate's radical corporate pivot away from European soccer and into Middle Eastern server infrastructure.
And it all funnels into this massive, inescapable push toward tokenization. And here's why this matters directly to you. Whether you are currently sitting at your kitchen table trying to plan your household budget around that 2.4% inflation rate, whether you're wondering how the back end of your debit card is going to process a coffee purchase next year, or you're wondering how the deed to your future house is going to be recorded without a notary, these digital ledger shifts are coming for your physical reality.
It is happening right now.
It really is.
The foundational plumbing of the world is being ripped out and replaced while the water is still running through the pipes.
Which leaves us with one final, lingering thought to explore. When Satoshi Nakamoto launched the Bitcoin network in the wake of the 2008 financial crisis, the explicit goal was to create a peer-to-peer system that completely bypassed the big banks. A financial system without rulers.
Right. That was the dream.
But if we look at the trajectory of 2026, it's everything from central bank money to the deed of a Dubai skyscraper to your personal identity becomes a digital token on a network and the legacy. Traditional banks end up owning and controlling those permission networks.
Yeah.
Did the crypto revolution actually democratize finance? Or did it inadvertently hand the traditional legacy institutions the exact tools they needed to build a faster, more efficient, and more absolute way to own the board?
That is the multi-trillion-dollar question we're watching play out in real time.
Something to mull over as you navigate this changing landscape. Keep questioning the data, keep looking for the hidden connections, and thanks for taking the plunge on this deep dive with us.